Perfect. Right. Cool. Well, thank you so much for having me on the program. So my name is Simon, and I am a finance PhD student on the job market this year at UC Berkeley Haas. So today I'll be presenting my job market paper titled Environmental Regulatory Risks, Firm Pollution, and Mutual Funds Portfolio Choices. So a quick motivation on what this paper is really about. So recently, institutional investors have become increasingly concerned about environmental risks embedded in their portfolio decisions. And in particular, environmental regulatory risks have been identified by both practitioners and academics to be of paramount importance over the next 5 years. And many institutional investors believe that such risks are already starting to materialize. And so the burgeoning literature in this area has primarily focused on the pricing implications of these regulatory risks. So for example, the pricing of municipal bonds, corporate bonds, bank loans, and shareholder wealth. But there has been relatively less work that looks at how environmental regulations interact with firm pollution and their combined impact on investors' investment decisions. So we try to fill this gap in the literature by looking at an important group of investors whose trading we can observe, which are mutual funds, and then examine how they rebalance their portfolio holdings of these polluting firms in response to environmental regulations. So what is the regulatory institutional setting of our paper? So we focus on a key regulatory component of the US Clean Air Act, known as the National Ambient Air Quality Standards, or NAAQS for short, for ozone pollution. Okay, so what are these regulations? Well, essentially each year the EPA in the US categorizes each county into what's known as an attainment or non-attainment designation status. Okay, so an attainment designation, so this is on the left-hand side. As an example, consider a county that has an ozone concentration level that is below what's known as a NAAQS threshold. Okay, so a NAAQS threshold is just a number that's set by the EPA. So for example, it could be like 0.085 ppm. And if the ozone concentration or pollution levels in that county is below this threshold, then we say that the county is in compliance, okay, or otherwise designated as attainment. Okay. On the right-hand side, we have an example of a non-attainment county where the ozone concentration levels are above the threshold, and so the county is in non-compliance, and we call that non-attainment designation. So what's the implication for firms that operate polluting plants in these non-attainment counties? Well, these non-attainment counties have more stringent regulations, and these firms have mandatory pollution abatement requirements, which leads to additional regulatory costs. And the important thing to notice here is that these non-attainment regulations are binding for firms. In other words, they impact on the firm's emissions behavior as well as their pollution abatement investment decisions. Okay, so for example, the impacts on kind of the raw materials that they use, what type of green technology they employ, so on and so forth. Okay, so all of this combined leads to an increase in the compliance costs relative to those firms that operate in attainment counties. Right, so we use in this paper these county level ozone non-attainment designations as an exogenous source of variation in local regulatory stringency, which represents a negative shock to the cash flows of the polluting firms that are exposed to these regulations. So what is the hypothesis of our paper? Well, essentially the argument is kind of this hedging against non-attainment regulatory risk, right? So we propose that these mutual funds will adjust their portfolio holdings in a rational manner to essentially hedge against regulatory risk. Now, the literature on this also talks about this hedging incentive, but comes at it from a different perspective, right? So we have papers like Pastor et al., Peterson et al., 2021 in the JFE that essentially says, well, you know, if you have green tastes combined with ESG demand, then this is going to lead to an increase in consumer preferences for green holdings, and this is also going to increase pressure on institutional investors to divest from brown firms. And combined, this may suggest that, well, green non-polluting stocks serve as an appropriate hedge, right? On the other hand, Baker et al. Argue that, well, this regulatory stringency could be due to brown firms increasing their output. right? So to the extent that brown firms' output increases, it's going to lead to increased emissions, and this is why this regulation is implemented. And so this is going to lead to a positive unexpected returns for these brown firms, and maybe brown firms are better hedges. And so the whole point of this is basically to say that, well, how mutual funds react, okay, which funds are underweight or overweight, is ultimately an empirical question, which we try to tease out in this paper. Okay? However, the mechanism that we propose is very different from the existing literature. So the existing literature is kind of all on ESG demand and green preferences, whereas here we have nothing to do with preferences, but rather it is this negative shock to the cash flows that's driving the portfolio decisions. Okay, so what's the mechanism? So in the first stage, while these ozone polluting firms that have greater exposures to these non-attainment designations have greater regulatory costs. Okay? And as a result, this is going to negatively impact on the firm's fundamentals, right? So it's going to have more riskier operating cash flows. And as a result, these funds will then optimally adjust their portfolio holdings depending on how the cash flows of the stock co-vary with the regulatory shock, right? So if you have a stock that performs better when this non-attainment regulatory shock hits, then this is going to be a regulatory risk hedge, and these stocks are going to be overweighted. And vice versa, stocks that perform poorly will be underweighted, right? So let me just talk about what kind of variation that we're going to use in our analysis, which may not be obvious from just a simple understanding of the regulatory design. So the main point here is that not all polluting firms are regulated uniformly under these NACS thresholds. So on the left-hand side, we have an example of a attainment county. Okay, so you could have a firm. The firm operates all of its plants in this attainment county. All of the plants emit ozone, but this county, well, this firm is unaffected by the regulation because the county is in compliance, right? It's an attainment county. So there's going to be a variation on the extensive margin of regulatory stringency, right, between counties. On the right-hand side, we have an example of a non-attainment county. Again, we have a firm. It operates all of its plants in this county, but none of the plants emit ozone. So they emit other pollutants like PM 2.5, could be lead or whatever. Again, this firm can be a heavy polluter, but it's unaffected by the regulations, okay, even though the county is in non-compliance because it doesn't emit the pollutant, which is ozone, that's being regulated. So that means there is variation in regulatory stringency on the intensive margin between firms within the county itself, right? So the nice thing about the regulatory setting in our paper is that we can really exploit this local variation in regulatory stringency and then precisely identify which stocks experience this additional regulatory costs given a non-attainment designation, right? And so the existing literature has identified two types of firms. The first type is a multi-plant firm. So these are firms that have plants that's been operated across many counties, and the literature has shown that these firms are regulated most intensely because they're generally targeted first by the regulators, and so they have higher production costs. Likewise, there is a firm that's called a heavy ozone polluter. So these are firms where ozone air pollution forms a majority of their total pollution, and these firms are shown to have higher operating costs as well. So taken together, if you have a firm that's both multi-plant and a heavy ozone polluter, then these firms will suffer the most negative shocks to the cash flows when they're exposed to these non-attainment regulations, and these are precisely the firms that we expect to be underweighted in funds portfolios. Okay, the sample or the data that we use is fairly standard, so I'm just going to quickly go through this. Let me just highlight one thing, which is the emissions data that we use comes from EPA's TRI database. This is a standard database, but most papers just use the chemical emissions, the total emissions. However, in our paper, it's very important to categorize the chemicals themselves into ozone and non-ozone, and there is no kind of categorization in the TRI database, so we hire a chemistry PhD to painstakingly go through 650 chemicals to map them into ozone versus PM, etc. Okay, so overall we have roughly 3.6 million observations at the fund stock quarter level over the sample period of 1991 to 2019. So let me just quickly talk about the regulatory design and how do we use it as a research design. Okay, so there are two ways which a county can go into non-attainment, right? The first way is that the ozone those ozone concentration levels in that county rises, surpasses the next threshold, and then it will be designated as non-attainment. Now that is potentially endogenous because areas that have more local economic activity will probably have higher output, and to the extent that these additional outputs is due to additional emissions, then that means the designation of non-attainment could be endogenously determined by unobservables that drive local economic activity, right? So we don't focus on that. What we do in our paper is we focus on policy changes in the next thresholds. Okay, so what I mean by that, well, if you have a look at this figure, essentially at 4 points in time, the EPA lowered the next threshold that defines compliance, such that many counties found themselves to be in non-attainment relative to the prior year, even if their ozone concentration levels remain constant. Okay? So that means these non-attainment designations are not due to changes in the pollution levels, but rather it is induced by the policy changes in the next thresholds themselves. And this is exogenous, right? So we only focus on these 4 peaks or 4 points in time.
Simon, just for planning, 5 minutes left, just to be clear.
All right, perfect. Sure. And so this is a very natural set-in for a difference in differences, right? So what we do is we focus on a 5-quarter window centered on each of those 4 peaks, and then estimate the following specification. So you may notice that there is no post here is because we take the average difference, right? So the dependent variable here is essentially the difference in the average weights of the post non-attainment period minus the pre non-attainment period. Okay, this is just to ensure we don't overestimate the standard errors because we have millions of observations. Then the 2 important variables here are NA ratio, which measures the number of polluting plants located in non-attainment counties divided by the total number of polluting plants of the firm. Ozone ratio measures the total ozone air emissions divided by the total emissions of a given plant averaged across all the plants owned by a given firm. Okay, and the rational hypothesis predicts a negative coefficient on beta 3. Okay, so here are the results. So you can see that across all specifications, we have this negative coefficient on the double interaction term, which lends support to the hypothesis. What's also very interesting is that the single variables have positive and significant coefficients, implying that there is this reallocation going on, right? So firms that are not affected by this non-attainment designation shock are overweighted, whereas those that are most negatively impacted are underweighted. Let me just quickly talk about the extensive margin effect. This is quite substantial. If you compare firms that operate all ozone plants, they're fully exposed to non-attainment designations versus one that doesn't operate any ozone plants, has no exposure to non-attainment. The difference is roughly a 10% drop in the dollar value of holdings, which is very big. Again, this is just to verify the identifying assumptions. You can see that there are no pre-trends driving the results, but there is this sharp drop that coincides with the non-attainment designation quota. There's a whole bunch of additional results in the paper, which for the interest of time, I won't go through. Let me just quickly go through 2 remaining results on different types of regulations. Okay, so this next regulation is known as a bump up. So a bump up essentially increases the intensity of regulation, which means that counties that doesn't improve their air pollution quality to a specified level will get bumped up from a lower classification to a higher one. And the idea here is that, if regulation is going to become intensified, the underweighting should persist. And we see exactly that. You can see that funds underweight the firms that are more exposed to these bump ups. And again, there's this reallocation going on. If we have a look at the pre-trends, there's no pre-trends driving the results, and the sharp drop that coincides with the bump up event quota. Another type of regulation is the exact opposite of a non-attainment designation. This is known as an attainment redesignation. Okay, so this is the exact opposite. If the pollution levels improve, then the EPA will lift the non-attainment designations, and so this represents an ease in a regulatory stringency. And so one should expect, if funds are hedging against non-attainment risk, the exact opposite, right? So now these most affected stocks are overweighted, and the ones that are not affected are underweighted, right? It's the exact opposite. And if we have a look at the event study figure, the exact opposite results as well. Okay. For the interest of time, I won't go through the last part, but let me just quickly summarize one alternative explanation, and then I'll conclude. So in the literature, there is another explanation that could explain underweighting, and this is due to a behavioral explanation, right? So the idea is that, well, if some fund managers have this local exposure to these environmental risks, they're going to underweight the affected stocks because they overestimate the kind of costs, right, of non-attainment. But in the paper, we kind of try to distinguish this from the behavioral explanation by looking at performance implications, and we show that the results kind of generally support the rational hypothesis, right? So that's kind of all of these tables. And so let me just conclude. So in this paper, we look at how mutual funds react to environmental regulatory risks. And what we find is that, well, they underweight the polluting stocks whose cash flows co-vary negatively with the regulatory shock. And these are precisely the firms that are heavy ozone polluting and also operate multiple plants across many counties. Okay, and so let me just kind of end on a note kind of for future research. Well, we show in this paper that these environmental regulations have, important implications for the allocation of capital. And so, if you shift capital away from these biggest polluters, well, it could potentially increase the value of these funds' portfolios. But on the other hand, this could also be detrimental to overall welfare, right? Because these are precisely the firms that need funding for the transition to a greener economy overall. And so I think it's very exciting in the future to look at, well, what exactly are the welfare implications that are induced by these environmental regulations. So thank you so much for your time, and I'm looking forward to questions and discussion. Thank you.
Thank you very much, Simon. I think we'll move directly on to Sean, who's an associate professor at the Empirical College in London. So once we get the technicalities up and running.
Thank you so much for having me here. It's my first time. Oh, sorry. It's my first time at EBA. I'm super excited. And also, I just moved from the US to London. And I'm so eager to learn what's going on in climate economics and finance in Europe in general. And Simon, thank you for this very interesting and very clear presentation. I'm just going to go straight to my discussion. I really enjoyed this paper, and I'm not going to repeat the key points that Simon just have made. I just want to highlight the many aspects that I think why this paper is a great paper. First of all, I think Simon is very clear in stating the contribution of this paper to the climate finance literature. And for me, I'm coming from the background of economics. I do environmental and climate economics. And for me, this also has very broad implications for environmental and climate economics and more broadly to policy making in the environmental regulation world, that I think I'm going to provide a few suggestions that Simon can further, extend your contribution to a more general audience. And I also really like the very neat research design. It's like this typical Berkeley style, really beautiful RDD figure and event studies. And I'm going to have a few suggestions on those too. I also really appreciate this extensive discussion on outcomes, mechanisms, alternative stories. And finally, I want to highlight that this is very, very policy relevant. And I'm going to provide a few suggestions to build this to more policymakers. So my comments are on three areas. First, I'm going to have a few suggestions on identification strategy. Also, for someone going on the job market, I feel like this is a time you can still have a high return of spending your time to polish your identification strategy. And the second is, I will also want to discuss a little bit more of how to interpret results to link to a broader audience, both in academia and policy. And finally, a few minor questions. Okay, so for me, like this is my favorite figure of this paper. It's like so beautiful. Everybody will just open their eyes when they see a beautiful RDD figure like this. And I've seen like quite a few of these figures from a lot of my Berkeley co-authors. They're very good at doing this. So I'm not surprised Simon has done this. But I I think my question more is about like, why stop at the first stage, right? I think Simon has like 2 sets of results. Currently, I think don't speak to each other like very directly. We have this first stage RDD. Basically, we look at how around this ozone threshold, what's the probability of non-attainment around this threshold. But that's a first stage on the policy treatment, right? And we also want to see, you know, a similar design or like exactly the same design on the outcomes we are really carrying here. Portfolio responses, firm and fund performances. So those are what I call the second stage RDD. Those are the real outcomes we care in this research. And I think there is a way probably we can discuss more to use cross-sectional data. I do understand that, you know, you mainly focus on event time, so you need this time variation. But I do think that you can also utilize your cross-sectional data to look at, for example, the fraction of underweighting around 0 to see if we still have this very beautiful discontinuity. I think this will become, you know, a very impressive highlight of your paper going forward. So that's my first comment on the identification. The second comment is on the event studies. And I'm sure Simon and a lot of you are aware of this new wave on in diff, especially one of the, so the AER paper is published by a French economist. He just moved from UCSB to Sciences Po. So I'm sure a lot of people are aware of this. So basically the problem of the traditional two-way fixed effects in diff is there is a very strict assumption that treatment effects are homogeneous. So in this paper setting, we have different events, right? Different policy treatments and also across different counties and groups. And if we assume this is homogeneous, and estimated standard two-way fixed effects, this may not line up with the reality, which there may be, you know, heterogeneous treatment effects across different events, across different counties and groups. And in this case, estimates may or may not be biased. So I think this is the empirical question. In one of my recent research, we actually found that the traditional method can give very biased results, or almost opposite results. And it's very useful to try the neo-DID methods, and at least a few of the most useful references here for Simon to give it a try. Okay. So that's, sorry about, you know, I know identification is the most annoying comment ever, but I want to move on to more interesting and fun discussion about interpretation and policy implication. So I like a lot of results in this paper, but I think table 7 is my favorite, where Simon is showing that the portfolio response only responds to unexpected non-attainment designation, not to expected ones. And I think this really leads me to further think, right? What's the policy implication? Can we go even further to discuss, for example, what's the magnitude of differences of negative cash flows between expected and unexpected regulatory shocks, right? Like how big is the difference here, is why we see 0 from expected shocks. And also what's even more relevant, I think, is to ask what's the magnitude of difference in firm abatement costs in facing of those 2 different types of shocks. And why I think this is important, because I think this will eventually lead us to have this very important policy parameters for policymakers, which is the marginal capital allocation response with respect to abatement cost. And as Simon mentioned in the end of his discussion, that he planned to have future research on welfare implication. I think this is one of the value I really want to see, and this can be very useful to, you know, evaluate environmental regulations, and also for their marginal effect on firm and fund performances. So my suggestion is Simon may want to spend some time to expand the last contribution of your paper in your introduction to a more general interest. So here is why I think you could talk to a broader interest, maybe go for top 5 general interest journal to really talk about the real impacts through, you know, capital allocation, which I think is not just relevant for environmental econ finance literature, but also very relevant for policy making. I think the key contribution here, what are the effects of raising the stringency of environmental regulations, which increase the payment costs of firms through capital market? No one has answered this in the massive econ literature before. I think Simon is really the one to take on this new value to estimate this, a new mechanism and how environmental regulations could affect firms. And this will also be useful for policymakers to consider, cost-benefit analysis of the environmental regulations by considering this new value. Okay, so those are really like my main suggestions, and I have a few minor questions that we can really go to detail later. I will just go through them very briefly. So in table 7, I really like the results of non-attainment designation, but we also see, funds respond positively to attainment redesignation. So in that case, I wonder if there are symmetric effects with opposite sign, no matter how, their magnitude compare, but I would want to see, a positive shock would have, opposite sign of effects on firm and fund performances. And finally, I also really like table 10, where someone is able to observe firm abatement behavior. This is like really, really hard to gather data. So I'm super impressed by the very detailed data Simon has gathered to test each of those possible abatement behavior. And I think you should spend a bit more space to highlight this, especially to the econ audience. They really care about abatement cost. And I think a useful practice is to find out associated abatement costs in dollar term, related to those behavior. And again, this is related to my earlier suggestion to estimate the marginal effect of capital allocation with respect to cost. Okay, that's all I have today, and I look forward to more future research and policy discussions along the line. Thank you.
Thank you very much. I don't know, Simon, do you just want a quick reaction on this?
Yeah, sure. Thank you so much, Sean, for your wonderful comments. It's really helpful. So just a quick question. A quick response to your capital allocation. I think you're right. I really wanted to try to push on this a bit more. The only kind of downside here is that getting dollar costs, or the dollar value of pollution abatement costs is almost impossible, unfortunately. So that's why, kind of in that table 10, I look at observable behavior. It's that, as far as I know, I don't think there is any data that is possible to get on actual abatement costs. So unfortunately, I'm going to try to think. I have some ideas in mind, maybe using, there's like these pollution offset markets, which I can use to kind of proxy for that. Perhaps that might be like a completely new paper though. But I think that is a very valid point. And I think the policy implications can be teased out a lot more, especially through this capital allocation channel, which I think has been relatively understudied. Your comment regarding this firm fund behavior, performance, whether it's symmetric or not using attainment redesignations, that's I haven't actually tried that. So that's very easy to do. And I think I'll definitely take that on board. And your comments regarding kind of using this new wave of DID papers, yes, that's also in the pipeline. I'm going to do that as well for sure. And with the RDD, I'm also thinking about the second stage as well. There's just a bit of problem there because kind of the units don't really match up nicely. In the first stage, we have kind of county with county, but then second stage is more like, firms operate plants across multiple counties, right? So then it's kind of hard to kind of do the second stage, which is why I kind of use this diff and diff. But I think there are ways around that, which, this is going to be kind of strengthening the identification more. But thank you so much. And I'll definitely email you to get the slides off you. Thanks.
Oh, I just want to provide one, I don't know if it's useful insight. I'm actually looking into the EBA's database. They actually have a very good database on the abatement cost of power plants in dollar terms. I don't really know how many of those firms are power plants, or do they also have, the data for other firms? But I will send you the link, and you can see if that's useful.
Yeah, no, thank you so much. Yeah, I've looked into that. So the problem with power plants is that they don't. I've looked at that, and hardly any of them emit ozone. So ozone is kind of weird in the sense that, it's kind of like, it's not really a chemical, it's actually like a mixture of chemicals, and the power plants emit mostly kind of greenhouse gases, and ozone is kind of, there's different chemicals. So the overlap is very small there. So unfortunately, I couldn't exploit that data. But thank you so much for that suggestion as well.
Okay, so time for questions. I don't know from the audience or from the chat. Just 1 minute.
So, Simon, I guess to you, right? The welfare implications. I mean, I don't know. I was thinking that from the market response you have, I guess there is an implied cost, right? I mean, if you're, or was it 1.7% drop or 10%, depending on what you look at, that's an indicator of the cost, right? Somehow, 1, 2. I mean, it's redistribution effects between people mostly, right? I mean, I'm being, let me be a naughty bureaucrat and say welfare, who cares, right? Bob wins, Alice loses. From a societal perspective, tough beans, but is that my problem, right? So I guess my challenge to you is, now that you're putting your neck out and saying welfare implications, what did you have in mind exactly?
So I think the discussion also kind of got to this point as well, is that, well, these non-payment designations, well, if you look at it from the fund's perspective, they're just maximizing their returns, right? Maximizing their financial performance. But these are precisely the firms that you really want to give the fund into, so that they can actually improve their pollution, right? So they don't pollute as much. And so it could be the case. So I don't know. I haven't looked into this, but it could be the case that these polluting plants are located all in places where the economy is not that good, or it's like a lot of minorities there. And so to the extent that you're taking funding away, or capital, you're moving the capital away from these polluting firms, you may be kind of you're taking away this distribution of wealth, which may be marginally on a marginal, right, per dollar of investment in one particular area may be greater than some other area that doesn't need it as much. So and to think about the welfare implications for this is, I don't know exactly, I haven't really thought about what research design I can really use to exploit that. Pollution abatement cost is certainly one thing that one could look at, but the data for that is just very hard to get. So but that's just kind of some food for thought for the future. Yeah.
I also have one question, and then we can wrap up. One of the things, so what I was struggling with was reading the paper in terms of this, that you have a data sample from 91 to 2019, which is a very long period, on whether these effects are stable over time, because I would not expect that to be the case. I would expect that this has increased. So we've heard a lot about convergence trade due to green coming in the later years, and also the literature kind of saying this, that this repricing risk is there, that this is a pricing factor which has not been taken into account. So it's also unclear whether this is something that we get to a new steady state at some point, or whether the convergence trade is going to continue. Have you looked at the time effects on this, on whether these effects are stable over time? Because that seems quite relevant to kind of also explain that in 1991 we knew about the greenhouse effect, but it was not something that was perhaps in the popular opinion as it is today.
Yeah, no, that's a very good point. So I've done subsample analysis looking at the 1991 designations, 2004, 2008, and so on and so forth. So if you look at them separately, there is still this effect, and I didn't get time in the presentation to go through this, but this is due to the unexpected component. So the idea there is that, yes, I completely agree that the anticipated component. So for example, if your pollution level is so far above the threshold, well, it doesn't matter how the threshold is going to change. I know you're going to still be non-attainment, right? And so part of that is it's going to converge to like a steady state. I mean, you're going to take into consideration this risk before the event even happens. But the idea here is that the pollution right around the threshold is due to random fluctuations, right? It's like due to weather, it's due to different, temperature, etc. And to that, no matter where you are in time, that is essentially unpredictable. And that's kind of where the RDD kind of, which I didn't get time to present, but that's where the RDD analysis comes in, is that, well, if I'm, in this narrow window around the threshold, it doesn't matter if I'm, kind of trying to predict, how that county is going to end up. It's very hard to do that. Even if I can try to predict it, I mean, next year the fluctuation may just fluctuate to be above or below, and that's going to be kind of random. So that's why in the paper I kind of show that it's the unexpected component driving this, and that kind of persists throughout time. At each one of these policy changes in time, you still see this underweighting effect that goes on. But yeah, that's a very good point. Thank you.
Okay, let's wrap up here. Thank you very much for a very interesting paper. I think